Well, we're coming in hot for this special episode of Plugged In. I'm feeling feisty. I'm feeling excited. I'm Al Dominic with my man, Steve Williams.
How's it going, bud?
Well, it's been an interesting few days, a few weeks, a few months.
Yeah, we got to get caught up on.
We got to get caught up on this
stuff going on here. Good to be both together in Scottsdale at Cornerstone HQ.
Cornerstone HQ, we're throwing it down because there's some big stuff that's hit our industry that we care about. And we know we got some fighters out there that are trying to make sense of what's coming.
Yep.
And so, easy as it would be to look backwards, this is going to be a forward-facing episode of Plugged In with, of course, a little dose of creativity. Because where else can you get great music references that range from Frank Sinatra to 50 Cent? I think only here on Plugged In. So
you can get music references, but not with banking. The two only come together at Plugged In. So let's get rolling.
Well, why don't we have a gentleman's agreement? We will do a better job today saying not just the artist in the song, but also maybe give a lyric or two and explain why we think this ties into the business of banking.
Let's roll.
Let's roll with some lessons learned from the 4 recent bank failures. So we put this up on the screen behind us, and it's kind of a sad moment because we're taking no delight in seeing Silicon Valley Bank, Silvergate, Signature, and First Republic go the way they have. We've worked with a number of those banks. We know the leadership teams at all of them. Really, rich histories that we're going to be looking back over the, coming months and years to say, like, what went wrong. But I think there's some lessons from these failures that we should be talking about. And the musician that I think we should use is Old Blue Eyes. Because,
Mr. Frank,
regrets, I've had a few, but then again, too few to mention. And if you keep listening, he likes to wrap up his song My Way by saying, let the record show I took all the blows and I did it my way.
Yeah.
So, throwing one out for these guys, they did it their way, and for a long time it worked until it didn't. So
yeah, and I think a good lesson here, what we got to take some lessons away. One, there was incredible personality niche to these institutions, and then there's that lesson, when does a niche become a risk because you're too concentrated? We're going to hear a lot of bankers talking about that in the future, and what should their franchise look like? What will the regional bank franchise look like when niche is one way that you differentiate from too big to fail, but it has to be more of a portfolio of niches versus the one niche that can take you down.
Which speaks to concentration concerns. And so if there's words being thrown around, we're hearing concentration a lot. What's interesting is we talk about rates and interest rate risks that are there. I read something by Sheila Bair, who was the former chairwoman of the FDIC, and she said, essentially, these risks seem confined to a small group of banks, and really the vast majority of regional and community banks are just fine. So I think we've got to be careful about the narratives that are being spun, because if we're told that Silicon Valley Bank and First Republic are community banks, somebody's taking liberties with the way they describe what's happened.
Yeah.
So again, when we're talking about the lessons learned, I think I'd encourage everyone to take a minute and really think about the information they're looking at and use their own experience to make sense of what actually transpired. Was it truly just a failure of risk management? Because I've seen some really smart folks say, hey, let's just boil it down to its simplest parts. There wasn't the proper internal controls.
Well, and I hope we can stop the contagion of Monday morning quarterbacking and really learn from systematic things like this. First of all, Kevin O'Leary, Mr. Wonderful, on Fox News yesterday saying, with these banks, they were negligent boards with idiot management. I'd like to, flip him the bird on that. Now, again, let's put this in context and talk about degrees. We had a 500 basis point rise in short rates in a year, and that's never happened in the history of us watching this stuff. And at the same time, we had the rise of a highly interconnected, digital-first, socially wired banking system. Now, should we have all been thinking about that with our ERM programs? Absolutely. That's what we're in the business to do. Are those two pretty colliding events that really became unique for these kind of institutions? Yes. So I think it underscores the need that you're never done with risk management. But it does not mean that these are gentlemen and leaders and ladies of the Charlie Keating ilk. These were folks who I believed in relationship banking, believed in customer service, believed in things like that. So some of the names I'll throw out there, Jim Herbert at First Republic, longtime CEO Ken Wilcox at Silicon Valley, who got so many loans into tech companies that wouldn't have had them had there not been an SVB. Joe DiPaolo, who created Signature Bank around the idea of relationship. And I don't want their their legacy or their history to be all of these sound bites like Kevin.
Well, and again, maybe Kevin's trying to apply for an open slot that Fox now has. But I agree with you. I think we have to be balanced and understand we're in an industry that prizes risk. I mean, the business of banking is inherently risky. Mm-hmm. So when we talk about the Federal Reserve and this pattern of interest rate increases, it might be nearing an end, but it also, is going to still be felt. So I'm worried about some of the economic damage that's been done and could continue to occur. The peak period of pain is something I was told earlier this week is still potentially coming.
Sure.
And so if we're going to start taking victory laps because we're not the first republic that failed, let's tone it down a notch and just make sure we understand enterprise risk management and embedding that in your front line. That's still a major opportunity and issue that needs to be addressed.
As we sit here in an afternoon in May, the KBW Regional Bank Index trading a little over 6 times earnings. So obviously people are looking at the regional bank model right now and wondering what happens next, which kind of leads to our second song, which is kind of what are we going to do performance-wise about this, right?
Well, you want to perform a little of this second song? Or do you want me to bust out
Whenever I hear this song, I think about the movie The Hangover, and there's a great scene where it goes, how do I get my money right?
No. Okay, so we're gonna since we can't afford this. See, I was thinking if we went from Frank Sinatra and we took like 50 Cent, I could just ghost against his entire album of "Get Rich or Die Trying," right? Because this is like the curse of the efficiency ratio that we all have been living with. Mm-hmm. So it's not about necessarily what's going on now; it's dependent on the next quarter of activity. So 50 Cent from one of his songs, which I think is In the Crib, but I could be wrong, says, "My flow, my show, it brought me my dough. That brought me all my fancy things. My crib, my cars, my clothes, my jewels. I done came up and I ain't changing." So, where else on Plugged In Again can you get 50 Cent juxtaposed with Frank Sinatra? I would beg any podcast to throw their throw their playlist our way. But I do think that what's been done in the past is not going to be what, gets us by in the future. And this curse of the efficiency ratio is something that we should be talking about.
Yeah, bankers were very proud of how they got regional and mid-sized bank efficiency ratios down to numbers we wouldn't have imagined 20 years ago. However, a lot of that was a function of the environment. Money supply was growing, rates were low, balance sheets were growing. So obviously, as you're expanding with cheap money, it looks like you're efficient. But from a customer experience, productivity back office, I think that's why there's some concerns. And I wanted to read out a quote from Adam Crisfulli, who used to work at Chase. Now he's at Vital Knowledge. And this is his take on regional banks right now. With funding costs rising, interest income past its peak, banks are likely to face losses in the coming months, putting regional banks at a disadvantage for investors. And this is what got me. Investors are viewing them like, quote, stodgy brick-and-mortar retailers focused on selling non-perishable commodity products at the advent of Amazon. And so, you think about that, you do not want to be pigeonholed as an old business model, but there's going to, for regional banks, community banks, there's going to be a lot of pressure that's exactly what you are. So that's where strategy comes in. That's where we've got to talk about performance, and you can't invest in a franchise at a 40% efficiency ratio. It's got to be, how do we be productive, but have a strategy?
Yeah, and I think this is where we, as industry leaders, can really show that we prize speed and agility in ways that outsiders would say that's not going to just open you up to incredible risk. So when I say, becoming maybe a better guardian of speed, it's speed to decide, speed to deliver, speed to market, right? It's speed to adjust to problems that you're trying to solve and crises that might be coming up. Because, I look at what's happened over the last 3 years, we've unfortunately been caught on our back heel. So whether it was COVID coming out and then the Triple P rollout the first time where everyone scrambled to get things done, there wasn't a lot of thought. It was just, we have to respond. Second rollout, a little bit better, but now we're having, this crisis of confidence yet again, and we're being forced to react. I think the strategy part that you talk about is so important for banks and their boards to actually pause and say, the strategy of what we don't want to do is even more important today than what we do want to do.
And if we all become risk-averse vanilla ice cream because these high-personality folks failed, I think we're going to get ourselves in trouble. You're worried about everybody getting so risk-averse
it's my
that
greatest
we don't
concern.
get creative. And I think that's important. As tech comes more into the how you create value in financial services, we've got to be creative. We've got to be design thinking, tech driven.
Yeah.
I just hope that doesn't die with a regulatory reach right now and just kind of risk off in the environment.
And to elaborate, we don't want, we're using music as a, as a tool for this podcast. You don't want the same song over and over and over again. This whole story of banks becoming dumb pipes, becoming just another utility company, like we've heard this over and over again. Like it doesn't have to be our fate.
Right.
And yes, my concern for the institutions of banking that are well run today is this could be used as an excuse to pull back on some of your ambition. And I really hope that's not the case.
Yeah, I hope it's, very differentiated, niched institutions with great risk management.
Yes. And so
smart risk management.
And you were talking vanilla ice cream. I thought you were going to talk Vanilla Ice because, we do like, artists like him. But if you want a vanilla artist, you could maybe go to Canada and find a few.
Some corporate rock. Let's throw some corporate rock.
Yacht rock? Yacht rock comes out?
It's not yacht, it's corporate.
Okay, it's elevator music that you might listen to if you happen to like Bryan Adams. Cuts like a knife.
Cuts like a knife, but it feels so right.
Oh, so I was on the road the last few weeks, and I came back telling Steve about a conversation with a CFO that I really respect, and we were getting into a conversation around the M&A environment that we're a part of, and there's been no deals. There's only a handful announced, with the exception of J.P. Morgan and their acquisition. But it strikes a lot of people, I think, that there's pent-up demand to start seeing acquisitions return. So I'm hearing it'll be Q3, Q4 when we're going to start to see this all coming. But it's not happening right now because in this guy's mind, why would I do a deal when knives are falling from the sky? Right. And I just kind of like that as an excuse as to why aren't things happening? Well, the falling knives are going to stop you from taking unnecessary chances.
Yeah, it's quiet right now. It's crickets right now in M&A, except for a couple bold ones we'd have to note, and that would be Frank Holding at First Citizens, who obviously took SVB, and Tom Camgemi, who took for New York Community, who took Signature. Pretty bold moves for bankers saying, I believe in the future of this industry. I think these are great client bases, great bankers. We wish them luck with that, but it's mostly crickets on kind of the healthy mergers. I agree with you. I think later this year, next year is going to be busy, busy, busy. What we want to make sure, though, is that, because people think we've got to get scale now because the cost of regulation is going to go up. And like this quote I read, income is going to be under pressure. However, I would warn us, it did not create a new innovator when Sears and Kmart merged. Last I heard, that was still liquidating down to almost nothing. So we don't want to be kind of a balance sheet combination that becomes an ultimate liquidation. We want to create franchises, and that's where I think we have to have some good discussions. What's that going to look like, the regional bank model in the future?
Well, that opens the door to, franchise value and how do you create and protect it. You can think about, to your point, culture fit and what that means for the audience that you serve. Just because you gain in size and scale doesn't make you more attentive to your customer base. In some ways, you can start to lose focus on what's made you successful. And what I find interesting for some of the banks of a, I don't know, 20, 30, $40 billion size, they have opportunities to go up if they want.
Right.
They're also going to be in the catbird seat for some of the smaller banks that are healthy, that are saying, hey, I want to tie my future to an organization of a larger size.
Yeah.
And I'm willing to invest in their future because I can go further with them than I can independently.
Yeah.
But it all comes back to this idea, you've got to earn your right to remain independent.
Right.
You've got to be a good steward of capital. And like everything in life, this crisis of confidence should give you an opportunity to say, am I the best steward of capital?
Right.
If I'm not, am I having the responsible conversations with others that could, do something for us?
And I think we could be careful out there, because scale alone is not going to be the answer with these balance sheets and franchises and delivery systems. I read a great LinkedIn post by someone said that tech company CFO, he said, my board said, go open some more accounts. It's some too big to fail. So for a complex business account, he told this story about how he couldn't get an appointment at B of A. He went into Chase, and the youngsters at the platforms all kind of went, ooh, a business account. So, that contextual knowledge around business ownership, entrepreneurs, there is a role for regional and community banks to do that in a modern way.
Yep.
And I think it's going to be a shame if we all, have to do that through 5 institutions. I don't think that's going to happen. I think the entrepreneurs are going to rise up. There's going to be a next gen of modern niche banks.
Yeah, well, I said that we were coming in hot. We both want to fight. We're not looking to punish people, but we want to be on the side of a strong, healthy community system. Like we need a financial services industry that is diverse,
right,
and is differentiated. It cannot be commoditized or homogenized.
So tech's going to be important there.
So
right?
tech will be important.
So let's spin another song.
Well, listeners may not realize one of Steve Williams' quiet favorites is Tina Turner.
Among us.
I mean, who doesn't want to acknowledge a little Tina love in their day? So if we're talking about fintech strategies that banks might think about, I think we should use the word operationalizing. It's a long one, but if we can operationalize a fintech strategy by using Tina Turner's lyrics from "You Better Be Good to Me" as the ground. So she says, "Oh, you better be good to me. That's how it's got to be now, because I don't have no use for what you loosely call the truth. So you better be good to me. Yeah, you better be good to me now."
I like your yeah. Well, here's the thing. Fintech and bank partnerships 18 months ago were cute. They were interesting. They were fun. We were, partying a little bit in the froth. Now a fintech bank partnership better work on both sides. So it's you better be good to me fintech and have something to offer and be able to implement it, integrate. On the bank side, you better be good to me. I need capital right now. I need a lifeline. Let's work together. And, an example I would use is about operationalizing versus the old let's look at fintech innovation kind of in a passive way is MVB Bank and Larry Mazza and Matt Dean in the group. They're getting their fingernails dirty with the integration of fintech and traditional banking. They're thinking about compliance and regulation. I think that is the work ahead in the next 3 years is operationalizing, like you said, Al.
Yeah, and I think, what I've been hearing is a lot of executives have made bets on these tech companies, and now they want to make sure that their investment is returning value.
Right.
And so they're taking a more disciplined look at what they have, and they might say, hey, I've got 180, 200 different relationships. I need to slim that down.
Right.
I rely on these relationships, but am I using them to the fullest extent? And so that's where I think this concept of truth and partnership really becomes front and center.
Right.
Because you can't play footsie and say this is going to work in a few years. Like both sides need to be honest with each other. Can you deliver value? Are you going to be able to help distinguish the performance?
Right.
Like MVB is seeing and like others are starting to explore.
Yeah, and I know you've talked to me about behind the scenes folks running out of capital runway, and are they going to be able to keep the doors open or they have to merge? I hope a lot of people are out there digging around in the fintech world with what needs to survive, what's going to solve problems. There's plenty of capital for the right ideas right now. So there's going to be a fleshing out of fintech while there's this thing of banking. And if we're too risk averse and we're not funding innovation, that's the problem. And the only way you have to separate the wheat from the chaff is get in there, start talking to folks, understand what they've got.
Well, in our What's Going On in Banking that Ron Shevlin authored and is talking about, we continue to find that tech spend is not decreasing.
Right.
So there's still an appetite. There's an appreciation for the abilities that others bring into your organization.
Right.
I just think the perspective has shifted. So I'm quietly interested in some of the KYC type companies that are helping to better understand where you have risk with your customer base.
Right.
So
if there's one thing these failures taught us is the digital front door and the digital experience, and we've got to be there. And now everybody's looking and saying, I've got to raise deposits. Well, if I don't have a good marketing function that's next generation, I can't open accounts digitally. I can't use my data.
Yep.
I'm going to be in trouble. And so even with this, quote, downturn or mini banking crisis, banks aren't going to stop investing in that transformation.
But I do think this is where you revisit your tech roadmap.
Yeah.
This is something that Cornerstone, talks about all the time. So again, full disclosure, we all live with limited time, focus, and resources.
Right.
It's a quote that is attributed to Steve and again, What's Going On in Banking. But this tech roadmap that most organizations have, you've got to revisit it right now.
Yeah.
Things have changed materially in the last few months.
Right.
And so understand your gaps, take some action on those.
Yeah, absolutely. And we're going to see compliance and risk and examinations around technology. We're going to see it around liquidity. So again, I have to bring that stuff in and be very disciplined. So compliance and risk need a seat at the table, but that's not to slow things down. That's to be smart about moving forward and being entrepreneurial. So with tech though, since we've last had a podcast, a continued movement on a big thing out there, what I called late November, the Chat GPT moment. But most importantly, Al, what's happened since then?
Oh, I've been blinded by the science. I feel like I need to bring Gary and Wyatt back so that they can, remind us that this concept of AI where like I have my dream woman, I type it into the computer and then, oh my gosh, she's here. She's driving a Porsche for me.
What was her name, the actress?
Oh, what was her name? Kelly LeBrock.
Kelly LeBrock. You can mail it in. Okay, so that was an interesting, weird science, not blinding me with science.
Well, I'm so torn up by AI. Like, somebody's going to have to, call me out on this. But, I think the artificial intelligence movement that we're, seeing right now, it calls into question just because we can do something doesn't mean we should do something. And so, from a banker standpoint, it's interesting to hear the interest without a lot of substance behind it. So there's, I think, the casual idea that, okay, this could help on the research front. This could help with some of our data and our modeling. But then on the corollary is, but you can manipulate data, you can manipulate models. You need to really understand the inputs before you get to the outputs.
Yeah.
And so, we're looking at some of the open job listings and postings. So I think you and I shared a Sam Altman position where it's like $375,000 for somebody who can help.
A prompt engineer. How to ask, how to feed the computer and ask it good prompts and coach it. I think that's a great example of what's changing. You were joking to me the other day, and I think I've seen both IBM and Dropbox kind of put signs out in front of their door says no humans need apply, only bots.
And believe me, I'm not laughing at you, Dropbox, because I was surprised to see, hey, we're going to let 500 people go, but we're going to bring 500 people in that can fill the role that Steve just said. Now, unfortunately, as podcast hosts, we will be rendered obsolete in a matter of days because the ChatGPT stuff could do a much more interesting thing than
better
us.
Song selection too. But I gotta say that what's interesting and why people are going crazy is the pragmatic applications. We had our young folks here at Cornerstone present some of that recently. I tip my hat to Chris Nichols at South State, who's been writing about this. And one of the most radical things Chris wrote about was South State doing a deposit generation campaign using AutoGPT. And I love how transparent Chris is, trying to share these ideas about how to use new technology. But I think the exciting thing right now is all the pragmatic use cases. But we're also hearing, obviously Italy and some of the large banks is what's the defense against bad things that could happen here too. Inside our organizations with information security and governance.
Well, I'm glad you're saying that because I think we're both optimists. But then, you see what happens when Drake and The Weeknd get spoofed and it becomes a top hit, even though it wasn't either of them. And you've got the major music labels pulling that down from Spotify and others, but it's already out in the wild. And so it's encouraging others to think, if I can mimic and emulate what a Taylor Swift type will be doing, that's scary. And so I took some notes for this. Artificial intelligence right now has its moment for ChatGPT, which is all text-based. But think about images and video, research, design, presentations, spreadsheets, productivity. There are companies that are in here that I've never heard of. And again, productivity, Zemly, Merlin, Tipley. Spreadsheets is like bot sheets and Sheets Plus. Presentations, Slides AI, Prezzo. There are companies that when you hear them, it reminds me of the early days of fintech, where it's like, who's doing what? Or the internet for that matter.
Right.
But they're making moves that we need to be aware of. And so, again, banks are rightfully focused on the moment that we're in, making sure that they're being smart, disciplined, that they're communicating to their constituents and their employee base.
Right.
But you can't sleep on the fact that this major technological shift has occurred and is now starting to mature right in front of us.
And if your bank talent executive has a value saying we support lifelong learning, will buckle in, because every adult right now needs to buckle in and learn about how's this going to change every institution, every business. And I predict, Al, by, say, 2030, whatever your non-interest expense to asset ratio is out there at your bank, cut 100 basis points off that because of between digitization, platform automation, AI, data analytics. It's going to be a smarter bank in the future, as our director of research, Ron Shevlin, would say. And what all these themes come together post the mini banking crisis of who is going to successfully build the smarter bank.
Yep. Now, to wrap this all up, the music that we should have cited is by Oingo Boingo. Weird Science. You're going to have to check that out. You're going to have to check out our Spotify playlist because while we can't stream them on this particular podcast platform, we do have a little shadow playlist that hopefully entertains. So again, a lot happening in our wonderful industry. There's some really strong executives doing some really meaningful work. We don't want to ignore the fact that, the challenges of 4 banks does not represent the industry as a whole. but we're all in this, and we're going to have to fight together, and we can do this as long as we're aware that, there's good days and there's bad.
Yeah, there's going to be a lot to report in the rest of the year on who's responding to this, who he thinks showing that speed, showing that creativity. So great to talk to you today.
Great to talk to you too. We appreciate Steve Williams, Al Dominic, the team at Cornerstone, and everyone who's getting plugged in with us. We'll catch you next time.